Barry, I'll start with you. You don't see any of these signs of recession on the horizon. You feel pretty good about where we are.
Reasonably good. Yeah. I think there's some nuance to this, in as much as, first of all, on the consumption side, the recent numbers have been flattered by the fact that we had a real downshift when the stock market imploded last year. And so this was very similar to what happened in 1987. The second quarter numbers were exceptionally strong. It continued all the way to July because of Prime Day in part. But basically, consumption's going back to trend of 2.5%, 2.75%. The numbers look softer in the third quarter because of how strong they were in the second quarter. The other thing I would add about the labor market is it looks significantly tighter to me. Now, there was a lot of concern about the average hourly earnings series. I don't know why anyone even looks at that one, quite frankly. The headline number's been around since 2006. It's very quirky. The non-supervisory series has been around since the mid-'60s. That's at 3.5%. And what's driving it right now is the retail sector, which is growing. Wages are growing at 4.8 with a 3.4% unemployment rate, which is shocking, right, given the retail apocalypse. And leisure and hospitality wages are growing 4.3. So low end, less skilled is driving those wage gains at the non-supervisory level. So to me, things are looking significantly tighter in the labor market for the first time. A year ago, wages were going up because the labor turnover had increased. Now it looks like it's actually getting tighter. The consumer piece is fine. I would say, though, comforting yourself that the consumer is fine and we can't have a recession is a little bit of a false way of thinking about things, in as much as we've had investment-driven recessions before, 2001 being an obvious case. There's no bubble, but at 49, when Truman got reelected, we had investment just absolutely collapse.
Investment meaning CapEx?
Correct, right? And so that, that fair deal was actually right of, or left of the New Deal, and when he got shockingly reelected, CapEx just collapsed, but it's a shallow, short recession. And I think the important thing to keep in mind there is, let's say we had an investment-driven recession. The median decline in earnings related to a post-war recession is only 13%. The median decline in the stock market is only 20%. The last two were big because bubbles burst. But that's sort of framing our downside. So I think this whole debate about recession is a little bit kind of dubious, because I just don't think downside is that great, even if we had investment completely collapse.
If we were to have an investment-driven recession, what does CapEx need to fall to? I mean, we're looking at about 3% in the third quarter year on year, maybe some negative quarters in 2020. And so does it have to go to negative, or?
Well, it has to broaden to the labor market, right? Okay. It can't just be businesses. Right. In 2018 were investing in capital and labor. Mm-hmm. This year they've cut capital. Labor's still okay. The growth rate slowed from, we originally thought it was 1.9% year on year to 1.3%, so it's slowed. But it would have to decelerate further to actually have that permeate and cause a shallow recession. But even then, I suspect it would be quite shallow. So.
Scott, it sounds like you're getting more conservative, that you want to go to neutral, you want to take risk off, you want to go to higher quality in equities as well as fixed income.
We have, Melissa, and you and I have talked quite a bit over the last year or so, and we've been leaning hard. We had been leaning hard towards stocks, towards cyclical sectors for years, but really in a couple of steps this year as the market approached 3,000. Our year-end targets 3030 in the S&P 500. We thought stocks were pretty close to fair value, and really for us, even though we have a constructive outlook, modest growth, modest inflation, really out through 2020, but the risks, the negative risks to that outlook have increased, whether largely this trade situation, global growth, or these negotiations going to go. We still have, obviously, Brexit to get through. A lot of debate on the Fed. You mentioned the Kansas City Fed president, what her views were on further rate cuts. So there's a lot of uncertainties here. I think the market is pretty close to fair value, just a little bit below our year-end target, as I mentioned. But, for us, I think right now it was prudent to not lean hard towards stocks. We still like tech. We still like consumer discretionary. Mm-hmm. We still like financials. But, we're not going to swing for the fences as really, to be honest with you, we had been doing for a number of years.
At the same time, what did you think of last week's price action? I mean, for all the volatility, we ended the week fairly flat. at the end of the day.
It was. I tell you, on the, Wednesday, on the big down day, that was a trading day. I mean, we came down, and if you were watching the charts, if you were watching the trend line off the December low, you knew there were a lot of stops lined up below 29.40. We ran those stops. We followed through. There was another trend line, a more minor trend line below that at 28.90. And when we hit that, we hit two technical sell stop levels that had big time sell stops all on the same day, and that pushed us down, and we've recovered since then. There wasn't a lot of follow through. I think that was a good technical sign, but certainly as I mentioned, the trigger there was that ISM manufacturing number. Is it going to come in that low again next time? Probably not. Maybe a little overstated if you look at the market numbers. But for us, there wasn't a lot of follow through to the downside. You'd have to say that technically, last week was somewhat of a positive. And as I said, when you look forward, fundamentally, I don't think we're in bad shape. It's these uncertainties over trade. Trade discussions, if China and the U.S. walk away, market's going to go down on that.